Hey there, and welcome back to our channel. Today, we're going to be diving deep into the Silicon Valley Bank crisis, one of the most significant events in the tech industry's recent history. In the early 2000s, the tech industry was booming, and Silicon Valley was the epicenter of innovation and growth. Startups were popping up left and right, and venture capitalists were pouring millions of dollars into new ideas and technologies. The Silicon Valley Bank, founded in 1983, was one of the key players in this ecosystem. The bank specialized in providing financial services to tech startups and venture capital firms, including lending money, managing cash flow, and offering other banking services. It was known for its innovative approach to banking and its willingness to take on riskier clients. The bank's business model was built around the idea of taking on more risk in the hopes of generating greater profits. It saw an opportunity to capitalize on the tech boom by offering more loans to startups, many of which were unprofitable and untested. By taking on more risk, the bank could charge higher interest rates and generate greater returns for its investors. However, in the early 2010s, cracks began to show in the bank's business model. Many of the startups the bank had invested in were unable to turn a profit, and as a result, they were unable to pay back their loans. The bank's loan portfolio began to deteriorate, and as the number of bad loans on the bank's books grew, investors began to worry. In 2013, the Silicon Valley Bank's stock price began to plummet, and investors began to panic. The bank's CEO, Greg Becker, was forced to make tough decisions to try to stem the bleeding. He cut back on lending to high-risk startups and laid off hundreds of employees. The crisis had a ripple effect on the tech industry as a whole. Many startups that were dependent on the bank's financing found themselves in dire straits, and some were forced to shut down. Venture capitalists became more cautious about investing in untested and unprofitable startups, and the overall pace of innovation slowed down. The Silicon Valley Bank crisis was a wake-up call for the tech industry. It highlighted the risks and pitfalls of investing in untested and unprofitable startups. It also sparked a broader conversation about the role of banks in the tech ecosystem and the need for greater transparency and accountability. In the aftermath of the crisis, the Silicon Valley Bank took several steps to strengthen its balance sheet and shore up investor confidence. It shifted its focus away from high-risk startups and towards more established tech companies with a proven track record of success. It also tightened its lending standards and increased its oversight of its loan portfolio. Despite the crisis, the Silicon Valley Bank has managed to rebound and remain a key player in the tech industry. Its focus on more established tech companies has proven to be a successful strategy, and the bank has continued to innovate and adapt to the changing needs of its clients. The Silicon Valley Bank crisis was a stark reminder of the risks and challenges of investing in the tech industry. It highlighted the need for greater scrutiny and oversight of banks and their lending practices, as well as the importance of responsible investing and risk management. Thanks for tuning into our video today. We hope you found this deep dive into the Silicon Valley Bank crisis informative and insightful. Don't forget to hit the like button and subscribe to our channel for more videos like this. See you next time. Don't forget to like and subscribe and leave a comment on any topics you would like me to cover.